I think Bitcoin is now emerging as something superior to that. Bitcoin allows you to take on a strategy of acquiring scarce, desirable property, but now you can acquire it in units of $20 at a time or $200 at a time, and so it's an egalitarian strategy for wealth creation or wealth preservation. The big catalyst here, I mean, the first one was, Satoshi's creation of Bitcoin, right? Put a big star on the map nearly 15 years ago. Coming up in a few weeks is the anniversary of the white paper. The second big milestone was the end of the block size wars, when Bitcoin was established, as this censorship-resistant network that's resistant to the meddling of corporate interests and others, and we sorted out what's the dominant chain, and a lot of theory and a lot of values got cemented in the block size wars. I think the third milestone is the entrance of is actually COVID and the entrance of corporations, right? COVID catalyzed corporations to look at Bitcoin. So without COVID, MicroStrategy doesn't do Bitcoin. And without MicroStrategy doing Bitcoin, probably the next set of companies don't do it. You don't get 24 Bitcoin holders, and then you don't get the accountants interested, and then you don't get fair value accounting, and then you don't get the clamor for the ETFs and the spot ETFs. So that was the next milestone. Then after that, the spot ETF will be the next really big milestone, because it'll be a high bandwidth institutional on-ramp for tens of billions or hundreds of billions of dollars of capital. And so that's really key. And then after that, the embrace of the traditional banking networks, right? The Deutsche Banks, the Santanders, other banks starting to custody Bitcoin and provide banking services. So all of those things coming together, they actually deliver digital scarcity as a fungible liquid asset to all classes of investors. Now, if we consider them, the retail investors will benefit. They've been engaged, but there'll be an order of magnitude increase in retail participation with spot ETFs because just about every working person has a 401k that's wired through conventional Wall Street money managers, and so you'll start to see the flow of those kind of funds enabled by the Fidelities and the BlackRocks of the world. And that will increase retail participation by an order of magnitude. I think institutional participation will also increase by orders of magnitude because the spot ETF. They really can't engage in the current structure because all the institutional money managers have accounting systems, compliance systems, control systems, risk management systems, that are all trading systems and collateral systems that have all been built over 30 years. And in that system, they can punch a button and buy $1 million of Apple stock, or $1 million of a gold ETF, or $1 million worth of the S&P index, or $1 million of bonds. And they can just do it instantly, and everything is accounted for. And if they make money, they get compensated. And if they lose money, right, they get criticized. And at the end of the year, their taxes get paid that way. And if they want to buy $100 million, their bank, like JP Morgan, fronts them the money, and so that entire system, which is a combination of technical functionality and accounting functionality and risk management functionality and financing functionality, all of that gets activated by the ETFs. So they will be able to participate, and we will start to see an evolution in portfolio thinking it's pretty clear that the 60-40 portfolio is a thing of the 20th century, and people are starting to question it. And so now I think you'll start to see portfolio models that might vary. If it becomes, when there's digital gold and people say, if you like gold, buy 50% real gold, 50% Bitcoin, right? Your portfolio models break and lots of capital flows into Bitcoin. When people say the 60-40 portfolio only made sense when there were only bonds and stocks, but now there's stocks, bonds, and Bitcoin, now maybe it's 60-20-20, or it starts to be 50-30-20 or something. And so those models start to change, and the asset allocations will change with them, and that'll have an impact. And then, of course, for operating companies, we just talked about it a lot. Now it's possible to be a treasury asset, and that means that maybe instead of operating companies remitting 95% of their cash flows back to their investors, what if they actually kept half their cash flows, right? So you might see a huge amount of capital move from institutional investors and endowments back to the operating companies, right? There's no reason why Apple might at some point end up with hundreds of billions or trillions of dollars of assets on its balance sheet instead of no net assets on its balance sheet. There'll be lots of interesting debates over it, but the point is now it's not even possible, and in the future it will be possible. I think that that Bitcoin will creep into sovereign balance sheets, both sovereign wealth funds as well as sovereign nations. It'll start with the smaller ones that are more innovative as a small percentage, and now over time it will grow. It's not going to replace the currency that's used as currency or the sovereign debt used as the lowest risk asset. It's going to replace real estate and equity and property and all the other things that people buy. It's like, if you're the sovereign wealth fund of Norway and you're comfortable holding $100 billion of S&P equities, you could allocate half of that to Bitcoin instead. And you might very well convince yourself that that's diversification and that's less risky. So Bitcoin does serves this new emerging role, right, which is as a diversifier. And I think that at this point it's probably worthwhile for us to come back to how does Bitcoin compare to sovereign debt as an investment asset. And if we think about that, sovereign debt is low risk money. It's a monetary investment. I've got $100 million in cash flow, and I have to hold it somehow. So I've decided I'll invest 90 million of it in treasury bills with a duration from 3 months to 12 months. Low duration risk, low credit risk. I'm getting some yield. I'm holding it as a currency substitute of sort. What's the negative, the positive, and how do I compare it to Bitcoin? Well, Bitcoin is a non-sovereign store of value bearer asset that does not generate yield. Treasuries are a sovereign asset, sort of a bearer asset for most people think of it that way, although it's not quite. But it has counterparty risk in a couple of ways. It has counterparty risk over the long term because there's inflation of the unit. It's currency derivative. It doesn't have counterparty risk if it's the reserve currency of the world, but every other piece of sovereign debt has counterparty risk because Argentine debt instruments get defaulted on. Nigeria might default on their debt. So most nations other than the United States could default on their debt, and they could do a soft default, or they always have this option of a subtle default, which is I'm just going to print twice as much of this stuff and I'll pay you off in the currency unit, but I'll devalue the currency unit. So So I'll devalue my currency to pay you off. And maybe I'll devalue you in the near term, or maybe I'll devalue you, like, if I basically issue a bunch of 10-year bonds in the euro, and in 10 years I told you that there's going to be 10 times as many euros in circulation. Well, then you don't want to be holding the 30-year euro bonds. You might not be devalued in the next 12 months, but you're getting devalued in 10 to 20 years. And so the 30-year euro bonds are going to mature worthless, right? So sovereign debt has a lot of that kind of duration counterparty risk, and with every country, every kind of sovereign debt has duration counterparty risk because they can change their monetary policy. And then all of the weaker countries, the second, third tier countries, have credit risk as counterparty risk. And even if you have no duration, if you have 90-day sovereign debt from the United States, you still have sanction counterparty risk. If you're on the wrong side of the nation in a war, then you're going to find yourself sanctioned, and those instruments are going to be canceled. So they are securities. They're securities issued by a government, right? A nation state, and they're senior to, of course, a whole class of other credit securities like the municipal bonds that are issued by cities like New York or states, or of course, corporate bonds and other kinds of bonds. Bitcoin is advantaged to those sovereign securities in a variety of ways. One is there's no counterparty, so you don't have a council that sets monetary policy. That's a big advantage. The second is there's no nation state behind it, so that's a big advantage. The third is it is a asset you can self-custody. It really isn't practical for a corporation to custody $1 billion worth of government bonds. It's very, you're going to have to put it in a bank. And the issue is, if you have government bonds in a bank in the middle of Africa, then maybe the bank in Africa seizes your bonds, even though they're U.S. bonds. So how do you actually move your money? If you actually make $1 billion in a country that's not the U.S., you convert your money into bonds, take a 10% haircut, then you take a 30% haircut to get the bonds out of the country. Then when they're in the next country, you've got 60 cents on the dollar left, and now you've just got the counterparty risk to the United States in duration, right? And so all of these are challenges you can't really manage with sovereign debt. Adoption's being driven by a variety of things. I have a price model for Bitcoin, and my price model for Bitcoin is the price is driven by the monetary inflation in the fiat currency frame of reference. That's one part of it. If the currency is hyperinflating at 100% a year, you're going to see Bitcoin price in that currency going up faster than that, or at that rate. So that's the first driver, inflation, but it's a vector depending on the currency. The second driver is in this case the adoption of Bitcoin as a treasury reserve asset by the people and the institutions in the marketplace. So the more people that adopt Bitcoin, when you're a hodler, you've adopted it as a treasury reserve asset. People say, well, that's not using it. Of course that's using it. In fact, the single most important use of money is to adopt it as your balance sheet. If everybody on Earth adopted Bitcoin as their primary treasury asset, it would go to $10 million a coin overnight, and then up from there. So adoption as a treasury asset is second. And governments can do it. Institutions can do it. Endowments can do it. Religions can do it, families can do it, corporations can do it, right? I mean, every entity with a treasury could adopt Bitcoin as an asset. And there's a degree, right? Is it 1% adoption, 5%, 10%, 50%, 90%, 100%? Obviously, the more adoption, the more power. So that's the second driver. The third driver is technology or utility, right? If on the day that Apple says we built a Bitcoin signing device into the iOS phone or the iPhone, and now you can use your iPhone and your Apple Watch, and your MacBook is a multi-sig setup, or you can assign multi-sig between 3 members of your family with family sharing or something. When they do that and they make it instantaneous and easy, then you're going to see a big surge in adoption of Bitcoin, right? Technology drives adoption, and then you'll see a big surge in the price. Now, technology is not the only thing that drives adoption. What else drives adoption? Hyperinflation, right? Fear drives adoption. So hyperinflation is a marketing campaign for Bitcoin. Inflation is a marketing campaign for Bitcoin. Also regulation. When the regulators say that Bitcoin is a commodity, an asset without an issuer, that drives adoption. When they actually approve a spot ETF, that drives adoption. When FASB approves fair value accounting, that drives adoption. So regulatory clarity drives adoption. Awareness drives adoption. Education drive adoption. Technology, it's more important that Apple adopt Bitcoin than it is that your mobile startup adopt Bitcoin, right? If Apple builds Bitcoin into the iPhone, that's more important than the fact that somebody that wants to launch the next WhatsApp built Bitcoin into their app. So the behaviors of Apple and Microsoft and Amazon and Google, they're just like nation states, really. If China embraces, China says you can own Bitcoin, right? The more of embrace from China, the more embrace of the EU, the more embrace of the US, the more adoption. So those are the 3 first order drivers, adoption, technical utility, and inflation. And then the second order driver is productivity growth of the people that have adopted it. Right? In the extreme, and this takes you to the Austrian economics theory of sound money, if everybody uses our money, then the money, and if the economy grows its supply of goods and services by 2% a year, the money will get 2% more valuable each year, assuming the money supply is constant, right? So ultimately, it's not just about adoption, but like imagine the company that adopts Bitcoin also doubles their cash flows the next year, you see, right? So the productivity of the Bitcoin community will ultimately drive Bitcoin after we get through the first order effects. But the first order effects of inflation and utility and adoption, those things are going to dwarf every other factor. And all of these things are kind of a function of time, right? Right. One can say over time, information will spread, adoption will spread, people will build this into technology. Inflation is a function of time. So over time, you can say Bitcoin price is going up over time. The reason it's going up is because of utility, adoption, and inflation and productivity, because they're all functions of time. And that's my view on it. And as you can see, the real big question mark is what will each individual do? What will each family do? What will each institution do? What will each company do? What will every executive do? What will every nation state do? Everybody chooses how rapidly and how enthusiastically they adopt this asset class, and they adopt this network, and they adopt this protocol. Right? Bitcoin it's an asset, it's a network, it's protocol, and it's an ideology. And it is defended by computer power, electrical power, economic power, and political power. And right now, it's growing at a very rapid rate. The computer power is 420 hash rate. It would take all the computers in the world to attack it. Electrical power is 12.5 gigawatts. The economic power looks to be about $550 billion if I calculate the basis of Bitcoin investors. That's how much money's been invested. You can get to that back of the envelope estimate if you just take the 4-year simple moving average and multiply by the outstanding supply, and that's a pretty good surrogate for, on average, what people have invested to buy their Bitcoin. And then the political power is 220 million people that own some of it, right? And I mean, that's Google's best estimate right now. I think it's growing by millions every month. I expect we'll be 1 billion sometime this decade. And of course, people, 220 million people with $550 billion invested don't want their money taken away. And that's what drives their political behavior, and that's what drives the network.